The subcommittees will come to order. Without objection, the chair is authorized to declare a recess of the subcommittees at any time, and all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is entitled Examining the Relationship Between Prudential Regulation and Monetary Policy at the Federal Reserve. I now recognize myself for 2.5 minutes to give an opening statement. Congress tasked the Federal Reserve System with responsibilities for both monetary policy and financial regulation. A fundamental question for today is whether these responsibilities complement or conflict with each other. The stakes are much more than academic. Monetary policy and financial regulation play foundational roles in the economic opportunities that can and should be available to every American household. To fully realize these opportunities, we need monetary policies and financial regulations to build from the ground up. Only in that way can real goods and services, which include labor, reliably find their most promising opportunities and do so in a timely and efficient manner. Today, we will examine how this most basic of economic services can be produced more consistently and distributed more broadly. We will examine whether monetary policy and financial regulation should be housed under the same roof as it is in our Federal Reserve System, or if monetary policy and financial regulation could both work better with greater independence and accountability. If monetary policy and financial regulation do not work, then our economy cannot work. When monetary policies and financial regulations lack independence and accountability, even the most dutiful efforts from households and businesses cannot bridge the gap to our full potential. Viewed in this light, Americans are rightly disappointed with our economic opportunities. Despite 8 years of recovery, growth has been slow and weak, and our economy has yet to realize its full potential. The accumulated loss of economic opportunity has risen to almost $13 trillion. That's over $100,000 per household on average, and considerably larger than China's economy, the world's second largest. Putting an end to these losses is not enough. We must reestablish a more vibrant and resilient economy. The 3% growth we produced last quarter is a good start. To build on that promising economic report, however, we must make sure that our institutions for monetary policy and financial regulation are effectively organized. I look forward to testimony from this afternoon's distinguished witnesses on how we can do just that. The chair now recognizes the ranking member of the Subcommittee on Monetary Policy and Trade, the gentlelady from Wisconsin, Gwen Moore, for 5 minutes for an opening statement.
Thank you so much, Mr. Chairman. Good morning to our witnesses. I have to warn you to prepare yourself for discussions on the dual mandate of the Fed, despite the title of this hearing. The other side always wants to challenge the propriety of being concerned about employment, which sounds like a good idea to me. I don't know why we'd turn employment into a boogeyman, but that being said, the central question that the Republicans will be asking here today is whether Congress should hamper the Federal Reserve's bank supervision authority. Now, let me really quickly address the bad idea of creating a distinction between monetary policy and supervisory functions of the Fed as a raison d'etre for the GOP to cripple banking regulation through the appropriation process so that, they can come in and just take money away from the Fed if they don't like what regulations come down the pike. First, the Fed sets a single interest rate, and then those rates are transmitted through dealer banks. So the Fed uses the institutions it regulates as agents in transmitting monetary policy. Secondly, the Fed acts as a lender of last resort. So it makes sense for it to oversee and have supervisory functions over those institutions that may one day need liquidity support, unless you want the Fed playing behind the 8 ball in a crisis. Thirdly, the Fed, in its function as a central bank, sets leverage requirements and underwriting standards. These are both supervisory and useful and targeted tools to combat market bubbles. Fourth, the supervision provides valuable insight on the economic outlook, which plays a role in how the Fed sets monetary policy. Finally, the Fed, of course, is the systemic regulator of our financial system. Following the 2008 financial crisis, Dodd-Frank corrected a glaring hole, no, let me just call it a crater, in making the Fed the regulatory agency of systemically significant firms. The U.S. economy has grown post-Dodd-Frank, and the financial system is far safer and fairer for consumers. So the Wrong Choice Act is a little more than a poisonous tonic for a healthy system, and I would reserve the balance of my time, Mr. Chairman.
The gentlelady reserves. The chair now recognizes the chairman of the Subcommittee on Financial Institutions and Consumer Credit, the gentleman from Missouri, Blaine Luetkemeyer, for 2.5 minutes for an opening statement.
Thank you, Mr. Chairman. I appreciate the opportunity to hold this hearing with you, and thank you for your leadership on these issues. The Financial Institutions Subcommittee has examined the growing role and influence of federal financial regulators in the post-Dodd-Frank and Obama era. The Federal Reserve, in particular, seems to be taking its supervisory authority to unparalleled heights. Financial institutions operate in a world of ambiguous guidance and aggressive enforcement. There's a near unanimous feeling that document productions fall into a black hole, with the Fed providing little to no meaningful feedback on supervisory issues. Financial institutions also recognize that Fed policies are inconsistent. Several weeks ago, I had a conversation with two financial institutions that offered a nearly identical product. One Fed district expressed interest in seeing the product offered more widely. Another said the product was a danger to consumers and should be shut down. I've also shared the story of a small town in mid-Missouri that I represent that has been in Fed purgatory for 5 years. Fed staff decided it didn't like certain products to which the FDIC and state of Missouri did not object and in fact suggested be made more readily available. This inconsistent approach to regulation has a negative effect on the economy at the local, national, and global levels. Federal Reserve officials have said their work as prudential regulators informs their monetary policy decisions, helping them to meet the charge to ensure global financial stability. But the reality is that the Federal Reserve's regulatory regime does not necessarily translate to a more stable economy. So we ask ourselves whether or not it's appropriate for the Federal Reserve to be both a prudential regulator and the sole dictator of monetary policy. As I've said in the past, it's time to take the power out of Washington and demand a reasonable financial regulatory structure. It's time to ensure that monetary policy decisions that impact the daily lives of our constituents are made in a sound, unbiased manner. We have a distinguished panel with us today, and I look forward to the testimony. Thank you, Mr. Chairman, and I yield back the balance of my time.
Gentleman yields back. The chair now recognizes the gentleman from California, Mr. Sherman, for an opening statement for 2 minutes.
2 minutes? When we're talking about the structure of the Fed, we see a dramatically anti-democratic institution exercising governmental power. First, the New York Bank gets a seat on the Open Market Committee, whereas the California Bank, twice as many people, doesn't. Second, substantial Fed power is in the hands of those who are put on the board in an election by banks. This is the only institution of governmental power in our country where we have the not one person, one vote, but $1 billion of banking, one vote. Second, our system does not provide capital to small businesses. Other than SBA, small businesses are told, use your credit cards to finance business expansion or get some sort of shadow bank 36% loan. This is where the jobs, technology, and innovation is going to come from, but it won't come from small business if we tell banks they can't make a prime plus 5 loan. That's in effect what we've done. Back in the old days, you used to be able to go to a business that had a 1 in 20 chance, 1 in 40 chance of failure and still make a loan and charge a few extra percentage points. Now we've crushed that out of the banking system to the huge disadvantages of small business. Speaking of huge, too big to fail is too big to exist, and as the Wells Fargo example shows us, it's too big to manage. Finally, when it comes to the Fed, we need lower interest rates to create the labor shortage necessary to create major increases in wages in our country. And we have low inflation, so we can do that. Instead, we're told in this committee room, the Fed is often told to raise interest rates, and that is antithetical to creating the labor shortage that's necessary to help most Americans. And of course, we need more, not less, quantitative easing. Finally, the Fed was able to turn over $100 billion of profit to the United States government. We usually have the debt clock in back of our witnesses, and now we've been pressuring the Fed to stop giving us the $100 billion by reducing its balance sheet. I yield back.
The gentleman's time has expired, and today we welcome the testimony of Dr. Charles Calamiris, who is the Henry Kaufman Professor of Financial Institutions at Columbia Business School, Director of the Business School's Program for Financial Studies and its Initiative on Finance and Growth in Emerging Markets, and a professor at Columbia's School of International and Public Affairs. His research spans the areas of banking, corporate finance, financial history, and monetary economics. He is a distinguished visiting fellow at the Hoover Institution, a fellow at the Manhattan Institute, a member of the Shadow Open Market Committee and the Financial Economists Roundtable, and a research associate of the National Bureau of Economic Research. He received a BA in economics from Yale University, magna cum laude, and a PhD in economics from Stanford University. Professor Calamiris holds an honorary doctorate from the University of Basel. Dr. Stephen G. Cicchetti is the Rosen Chair in International Finance at the Brandeis International Business School, a research associate of the National Bureau of Economic Research, and a research fellow of the Center for Economic Policy Research. His research interests include monetary policy, the economics of financial regulation, macroeconomic theory, and price and inflation measurement. From 2008 to 2013, Professor Cicchetti served as economic advisor and head of monetary and economic department at the Bank for International Settlements. During his time at the Bank for International Settlements, Cicchetti participated in numerous post-crisis global regulatory reform initiatives. Professor Cicchetti holds an undergraduate degree from the Massachusetts Institute of Technology, a doctorate from the University of California, Berkeley, and an honorary doctorate in economics from the University of Basel. Mr. Jim Savon is a partner in the Washington, D.C. law firm of Barnett, Savon, and Natter, and is testifying today on behalf of the Financial Services Roundtable as a specialist on financial services law and regulation. Mr. Savon is a member of the Executive Council of the Federal Bar Association's Banking Law Committee and the Executive Committee of the Exchequer Club. He is a former Senior Vice President and General Counsel for the Association of Bank Holding Companies, and he served as the staff director for the Republican members of the U.S. House Committee on Banking, Finance, and Urban Affairs. He received his undergraduate degree from Denison University and his law degree from Georgetown University Law Center. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Dr. Calamiris, you are now recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Barr, Chairman Lutkemeyer, Ranking Members Moore and Clay, it's a pleasure to be with you today. And I'll deliver a summary of my written testimony, which I submitted. The Federal Reserve is now more politicized than it has been at any time in its history, and consequently, it's also less independent in its actions than almost any time in its history. As the Fed accumulates more and bigger political lightning rods of discretionary power, the Fed finds itself increasingly politicized and less independent, both in the realm of monetary policy and in regulatory and supervisory actions. With discretionary power inevitably comes attacks by special interests seeking to manipulate those powers. The Fed finds itself making political deals with special interests and their representatives, largely as a result of its burgeoning discretion. Also, Fed leaders routinely offered distorted and self-interested opinions about reform proposals, while pretending that their opinions should be viewed as unbiased professional analysis. Fed Chair Janet Yellen's August 2017 Jackson Hole speech was a full-throated defense of the status quo of financial regulation. But that speech ignored scores of studies that contradict the narrative that she offered. Many of the studies she ignored were written by economists working at the Federal Reserve Board, the various Federal Reserve banks, the OFR, as well as top academic researchers. Don't be fooled by the charade. Financial regulatory policy is unbalanced, unlikely to prove effective in achieving its stated objectives, and fails to meet basic standards of due process for a democracy operating under the rule of law. Reforms can fix those problems. And I want to emphasize, I'm here to talk about reform, not just deregulation. The ideal set of reforms would include clear rules to guide both monetary policy and regulatory policy, would avoid undesirable conflicts of interest, especially by placing day-to-day regulatory and supervisory authority in an agency other than the Fed, and would establish administrative and budgetary discipline over the process of regulation and supervision. A less drastic set of reforms that wouldn't remove the Fed from those activities could still accomplish a great deal of improvement. Specifically, if it were possible to establish clear rules governing both monetary and regulatory policy and impose administrative and budgetary discipline on the process of regulation, then even if regulatory and supervisory powers remained vested in the Fed, the problems associated with Fed conflicts and politicization would be substantially reduced. Requiring Congress to weigh the social costs and benefits that arise in regulation likely would limit special interest manipulation of regulatory discretion after regulations are passed. And I would refer you to a recent paper by two political scientists, Gordon and Rosenthal, for a discussion of how the delegation to regulatory discretion undermined the intended risk-limiting provisions of Dodd-Frank with respect to the mortgage market. Most importantly, to improve and depoliticize regulation, Congress must establish clear rules that limit the use of unaccountable discretion, must establish budgetary authority for regulatory implementation, and must limit the abusive reliance on guidance in regulatory actions by requiring a much greater reliance on formal rulemaking consistent with the Administrative Procedures Act. If this were done alongside the establishment of a flexible monetary policy rule, that would go a long way toward restoring balance in the regulatory process, depoliticizing the Fed, ensuring accountability of monetary and regulatory policy. These changes would have major positive consequences for the economy. Only by clarifying the goals of the Fed and requiring it to work within clear rules can regulatory and monetary policy be improved to make those policies focus on long-run objectives, avoid short-run politicization, ensure appropriate balance and due process in regulation and supervision, and make the Fed accountable to the will of the people. Thank you.
Thank you. Dr. Cicchetti, you are now recognized for 5 minutes.
Thank you. Chairman Barr, Chairman Luetkemeyer, Ranking Member Moore and Ranking Member Clay, and members of the committee, thank you for inviting me to present my views on the relationship between prudential supervision and monetary policy. The U.S. financial system is far more resilient today than it was a decade ago, and the likelihood of another system-wide crisis is now lower. As a consequence of post-crisis regulatory reforms, banks have more loss-absorbing equity capital than they had in 2007. They also face liquidity requirements. And the biggest among them must meet rigorous stress tests. Importantly, this new environment ensures that all large, complex financial organizations are much less likely to become a burden on the taxpayer. It is important that we build on this progress. Regulations must remain sufficiently strict, and supervisors must interpret and apply the rules rigorously. My comments today focus on governance. I will make 2 points. First, prudential supervision needs to be an independent function sheltered from day-to-day political influence with control of its own budget. And second, the central bank should be a lead supervisor supervising systemically important institutions. Starting with independence, we all agree that because of their ability to take a long view, independent central banks deliver lower inflation without sacrificing higher employment and higher growth. What is true for monetary policy is true for supervisors. Supervisors can maintain a long-term view if they are sheltered from political influence, including having control of their own budget. This form of independence gives them the ability to credibly enforce rigorous regulatory standards, thereby promoting financial resilience and reducing public costs. It is equally important that the central bank be a leading supervisor. Supervision is integral to the central bank's core functions as the lender of last resort, the monetary authority, and the organization responsible for the health and stability of the overall financial system. Let me explain why. To protect the integrity of the system and the public finances, the lender of last resort needs to be able to determine a borrowing institution's solvency and the value of the collateral being posted to back a loan. That is, a lender needs to know whether the borrower will be able to repay. This requires confidential financial assessments, knowledge of the firm's business practices, and the skills to value illiquid assets, all things that supervisors generally have. Importantly, this information has to be available to high-ranking central bank officials on very short notice. In some cases, decisions have to be made in a matter of minutes. So the quality of data must be without question, and it cannot be in the hands of people who may or may not choose to share it. Turning to the relationship between monetary policy and prudential supervision, to quote from Paul Volcker's testimony before the Financial Services Committee in May of 2010, these two functions are inextricably intertwined. As a practical matter, it is impossible to say where one stops and the other one starts. This is true because the people engaged in these functions operate as a team, sharing knowledge and expertise that each requires from the other. That is, monetary policymakers require supervisory information to evaluate the state of the financial system, and supervisors use monetary policy makers' understanding of economic prospects to evaluate the safety and soundness of individual institutions. Finally, there is the fact that the central bank is responsible for systemic stability. The Federal Reserve does not have an explicit financial stability mandate, but without a stable financial system, the Fed would surely fail to achieve their statutory objectives of maximum employment, stable prices, and moderate long-term interest rates. Identifying threats to the financial system requires specialized set of skills as well as day-to-day access, all of things that the Federal Reserve has to information. In closing, let me emphasize my firm belief that when supervisors are independent of political interference, complete with budgetary autonomy, the financial system is more stable and taxpayer costs are lower. Furthermore, a supervisory function is essential for effective and efficient execution of core central bank functions. As the lender of last resort, the monetary policy authority, and the guardian of the health and stability of the overall financial system, it is essential that the Federal Reserve remain a leading supervisor, especially for systemically important institutions. The American public would be ill-served if that were to change. Thank you, and I would be pleased to respond to questions.
Thank you. The gentleman yields back. Mr. Savan, you are recognized for 5 minutes.
Chairman Barr and Ranking Member Moore, Chairman Luetkemeyer and Ranking Member Clay, members of the subcommittee. My name is Jim Savan, and I'm appearing on behalf of the Financial Services Roundtable. Thank you for inviting FSR to participate in the hearing. A decade ago, gaps in regulations contributed to a financial crisis. Subsequent actions by Congress, regulators, and the industry itself have restored the stability of the financial system. Since the crisis, large bank holding companies have increased their capital levels by $700 billion and increased their aggregate holdings of highly liquid assets by more than 50%. Yet some of the regulations put in place since the crisis are holding back a more robust recovery. Data on loans to mortgage borrowers and small businesses illustrates this problem. Also, an analysis of post-crisis lending conducted by the Federal Reserve Board has found that lending growth by the more heavily regulated large banks lags behind lending growth of small banks. FSR believes that the goal of prudential regulation should be to promote both financial stability and economic growth. FSR appreciates the steps the Board has taken to tailor some regulations, however more could be done. I'll briefly describe some of FSR's recommendations for tailoring existing regulations, starting with the capital planning and stress testing rules. The capital planning and stress testing rules have helped FSR members build stronger capital positions and improve risk management practices. Recent stress test results show that large bank holding companies can withstand an economic downturn even more severe than the 2008 financial crisis. However, the rules could be adjusted without impairing their fundamental purpose. FSR supports more disclosure regarding the models used by the Board in conducting stress tests. Disparities in loss projections between the models used by FSR members and those used by the board create a level of uncertainty that impacts lending practices. The stress test results also indicate that we've reached a point where the capital and liquidity rules could be adjusted to promote more economic growth without jeopardizing financial stability. For example, FSR recommends that the supplementary leverage ratio exclude risk-free assets from the calculation of a company's total assets, and that the liquidity rule be revised to give more favorable treatment to certain securities and the runoff assumptions in that rule be aligned with historical experience. Resolution planning has helped FSR members rationalize operations and contracts, yet this requirement, combined with separate recovery planning requirements, is an area where greater coordination among the agencies is needed. As a result of the Dodd-Frank Act, the board gained regulatory authority over a number of insurance companies. While the board has indicated a willingness to tailor regulations for those companies, FSR believes the board could be more attentive to the differences between the business of insurance and the business of banking. FSR recommends that the board and other federal regulators revisit the Volcker Rule. For example, FSR recommends that the rule exempt institutions that are not complex or interconnected, and that the prohibitions on trading and investments be narrowed. FSR also has 3 general recommendations for better aligning financial regulation with economic growth. First, FSR recommends that prudential standards be based upon risk assessments, not arbitrary asset thresholds. Second, FSR encourages Congress to promote greater coordination among federal financial regulators. Enhancing coordination would not require a restructuring of the agencies. Greater coordination could be achieved through the enactment of a set of guiding principles, such as those proposed by the Executive Order on Core Principles for regulating the U.S. financial system. Finally, FSR recommends that Congress evaluate the impact of the current expected credit loss, or CECL, accounting standard, which we believe will require an adjustment in how bank capital standards are calculated. Thank you again for the opportunity to address the board's role as a prudential regulator, and I'd be pleased to answer any questions.
The gentleman yields back, and the chair now recognizes himself for 5 minutes of questions. Dr. Kalmiris, in Dr. Cicchetti's testimony, he argued that monetary policy and prudential supervision are complementary, and I believe he quoted former Chairman Volcker in making the argument that the two are inextricably intertwined. And I hear this frequently when I have conversations with Fed officials who make the argument that their supervisory activities inform their monetary policy decision-making. There are dissenting views on this argument. Vincent Reinhart, the former secretary of the Fed's Monetary Policy Committee, observed that if the FOMC made materially better decisions because of the Fed's role in supervision, there should be instances of informed discussion of the linkages. Anyone making the case for beneficial spillovers should be asked to produce numerous relevant excerpts from that historical resource. I don't think they will be able to do so. Lars Svensson, who served on the faculty of Princeton and as a deputy governor for the Central Bank of Sweden, presented research to the Federal Reserve Bank of Boston in 2015, arguing that, quote, monetary policy cannot achieve financial stability, unquote. And even former Fed Chairman Ben Bernanke expressed concern about expanding the Fed's dual mandate to also include responsibility for, quote, reducing risks to financial stability. So my question to you, Dr. Kalmiris, is could we enjoy better monetary policy and financial regulation if there was more independence and accountability?
Absolutely, and I think there's a confusion between, that often comes up among 3 different activities. One of them is called regulation, the other is called supervision, and the third one is called examination. Now, in the Treasury White Paper of 2008, where they proposed removing the Fed from day-to-day control over regulation supervision, they specifically pointed out that that would not mean that the Fed would be removed from constant contact with financial institutions and from participation in the examination process, which is necessary to its role as lender of last resort. And that is what Paul Volcker was referring to. And when Paul Volcker was testifying about those matters, he also pointed out, very much consistent with my testimony, that the increased regulatory functions that were envisioned in Dodd-Frank for the Fed were going to be a politicization problem.
Can I follow up right
So
there?
this is a very important distinction.
In the argument about politicization, can you give a concrete example or two of how the combination of Fed regulation and monetary policy politicizes each of them?
Yes. Well, the most common pattern over the past few decades has been Fed officials are extremely concerned about insulating their independence in monetary policy, and they often basically use regulatory policy as a sacrificial lamb. So they make political deals on the regulatory policy side in order to preserve the monetary policy autonomy. Now, they wouldn't need to do that if monetary policy actually followed rules, because then that would defend them against those attacks. So by combining the regulatory policy and the monetary policy, basically the Fed has been put into a position, I'm not attacking individual Fed policymakers, they've often been put in a position where they make concessions to special interests on regulatory policy in order to try to defend their discretion in monetary policy. I can give you a few recent examples. I think the Fed's complicity in Operation Choke Point was a disgrace. That was true of the other regulators too, by the way. But this was something where basically if we can have our regulatory officials engaging in Operation Choke Point, there's pretty much nothing that we can't have them engaged in. We're not protected in any way in living in a country, a popular sovereignty country under rule of law. And that was clearly under political pressure, and again, deals that are being made with certain constituencies. And I think that there are other examples. There has been rumors at the highest levels of the Federal Reserve, people I know, that actually members of Congress have been very involved in trying to get appointments to occur in certain Federal Reserve presidencies. I can go on. There's a long list.
In the remaining time, do you think that funding the Fed's regulatory and supervisory responsibilities through appropriations would strengthen monetary policy independence?
Absolutely, and it would, because it would, again, help to defend the Fed, policymakers, as all rules do, against this kind of special interest interventions. And I would also
My time has expired on that, so I'm going to have to cut you off there. But thank you for the testimony, and the chair now recognizes the distinguished ranking member, Congresswoman Gwen Moore, for 5 minutes.
Thank you so much, Mr. Chairman. And you know, as I expected, this is a tremendous panel, tremendous knowledge base, and I appreciate the witnesses for being here. I just feeling a little bit puzzled and confused because this hearing is talking about the supervisory responsibilities of the Fed and setting monetary policy and discussions about the independence of the Fed. And it's not clear to me how subjecting them to the appropriations process makes them more independent. I mean, I have meetings in my office all the time with bankers, people who want us to do this or to do that. And if you can get the ear of whoever is in the majority at any given time, and the appropriators, then you can wield your way. So it's not really clear to me how subjecting them to the appropriations process makes them independent. It's kind of oxymoronic. I mean, wouldn't you agree with that, Dr. Sarchetti?
Yes, I would. I think that...
And please give us the examples you weren't able to give us during your short testimony about how this works.
Yeah, there are a set of pretty, I think, very straightforward examples. First of all, let me start by saying that one of the Basel Committee's core principles for effective supervision is independence of the supervisors, including independent budgetary authority. I agree with you that it's very difficult to understand how giving politicians the control of a budget is a way of improving people's independence. I do agree, however, that in a congressional and a democratic process with the Congress, that it is your role to give objectives to to independent authorities and then to hold them accountable for meeting those objectives. The examples that I would point to would be primarily, there are two examples that I would point to domestically and several internationally. So the federal home loan banks were subjected to the appropriations process, and we ended up with the savings and loan crisis. OFHEO was subjected to the appropriations process, and we ended up with Fannie and Freddie on the government's as being in conservatorship. If I look internationally, I can point to the cases in Korea, Indonesia, where the crises in the late 1990s occurred, and those were crises that occurred as a consequence of supervision being political. And finally, I would say
How about
that
Zimbabweers? How about Zimbabwe?
well, Zimbabwe has even bigger problems. They don't have independent monetary policy either. So I think that these are in most of these other examples, we at least have independent monetary.
Let me ask you this follow-up question. I mean, unless I'm hearing wrong, it sounds almost to me that people are challenging the role of central banks globally. If we are suggesting a model where we create some new ghost agency that does the supervision versus our central banks, what are we proposing to model for the rest of the world, and how would this work? Central banks typically have the credibility because they're independent. Can you just
I think that's,
weigh in on that?
Yeah, I think that's an extremely good point, and I think that one of the things that I would say is that the lender. I emphasized in my comments, though, and you did as well in your introduction, about the lender of last resort function. I think the lender of last resort function relies extremely heavily on supervisory information, on the information about the safety and the soundness of an institution, and about the quality of the assets that it has on its balance sheet. If someone else is doing that, then what that means is that you're going to have the lending being done outside of the central bank. So as you point out, you would need to create a shadow central bank somehow, and I can't imagine having a second central bank.
One last question in my remaining seconds here. That's a source of confusion for me. If we're pushing for independence of the bank, I keep hearing this notion that we need to have some sort of monetary rule. We had Dr. Taylor here, for example. How does having some kind of rule square would be a bank being independent?
Well, I think we're out of time, but the answer is it doesn't really square with that. And what we need is accountability, is an objective that's set by you, the Congress, and then accountability for meeting that objective.
Thank you for your indulgence, and thank you.
The gentlelady's time has expired. The chair now recognizes the chairman of the Financial Institutions and Consumer Credit Subcommittee, Mr. Luchtenmeyer, for 5 minutes.
Thank you, Mr. Chairman. Before I begin my questioning, I'd like to recognize that we're missing a few of our colleagues today. Some, like Mr. Posey and Mr. Ross, are at home in Florida dealing with the aftermath of Hurricane Irma. Our thoughts are with them and all those impacted by not only Irma, but Hurricane Harvey as well. Our prayers are also with our friend and colleague Barry Loudermilk, who was injured in a car accident early this morning. Both Congressman Loudermilk and his wife were transported to the hospital with non-life-threatening injuries and have been released. We will keep both of them in our thoughts and pray for a speedy recovery for both Barry and his wife, Desiree. As we can see, life goes on, but life is affected, and it's very, very important. So as important as this hearing is, keep it in perspective. Thank you, gentlemen, for being here today. It's certainly an honor to be able to discuss with you some of the, we believe, some concerns and some information we'd like to get from you with regards to Fed regulation and monetary policy. Mr. Savon, I know that last month I sent a letter to Chair Yellen expressing concern over the FBO rule and the impact it would have not only on foreign banks in the United States, but also on U.S. banks operating internationally. We're on the cusp of seeing capital unnecessarily ring-fenced across the globe. Does that really contribute to global financial security? And as a follow-up, is there any argument to be made that the Fed's actions have dampened the global economy?
Thank you, Congressman. In my testimony, I expressed one of the major concerns of the roundtable is a lack of coordination and cooperation here domestically among the various federal financial regulatory agencies. That applies globally as well. And so the issue that you've raised is illustrative of the fact that there is a lack of sufficient coordination among international regulators that is leading to some consequences. And one of those consequences is ring fencing, where institutions are asked to trap certain assets and capital in certain locations and then do not have the ability and flexibility to move those as business needs.
And in your judgment, I assume you believe that does affect the global economy.
Yes, I do, and would suggest that there's a need for some kind of overarching principles that international regulators, including the Fed, could agree upon to avoid that type of consequence.
You know, you talked about the coordination not only globally, but you also mentioned within our country here. And one of the things, you know, I point to the Treasury report recently put out back in, I think it's June. And in the back of the report here, it has a lot of recommendations, and one of them deals with trying to stop the overlap of regulations, to find more coordination between all the different regulatory agencies. And, you know, I guess, and in here, it talks, it lists the agency that it should be applicable to, and it's got the Fed in a lot of these situations. Have you seen the report, and do you believe that this is a pretty good synopsis of what needs to transpire to improve a financial structure?
Yes, sir. We have looked at that report. FSR submitted its own set of recommendations to Treasury as they prepared that report. And many of our recommendations, in fact, are reflected in the final report. We do think there is a need for greater coordination among the regulators, and one of the specific suggestions that we have in the testimony today is that Congress could adopt some overarching principles to guide the regulators in their separate missions. The core principles that were put out in the executive order on financial stability would provide some guide for that.
You know, our good friend, the ranking member, seems to worry about the independence of the regulators. I can tell you, being a formula regulator, there's no reason for them not to have some oversight as well. Everybody needs to have oversight, and regulators need to have oversight as well. I think it's important. You also made a comment in your testimony with regards to systemically important financial institutions, and indicated that you prepared a risk-based assessment model versus just a threshold. Could you elaborate just for a few seconds on that?
Yes, I'd be happy to. In fact, the FSR specifically supports the legislation that you've introduced that would provide for the designation of systemically important institutions through some type of risk methodology rather than a simple asset threshold. We think that's a more constructive and tailored approach than what exists today.
Very quickly, you also talked about CECL. Could you elaborate on it just a little bit, explain what it is and your thoughts?
CECL is a fundamental accounting change that changes the way banks have set up reserves for the past 40 years. Previously, banks have, and today they still, set up reserves based on the probability of a loss, and then when the loss occurs, they'll book the reserve.
How does that affect the monetary policy?
Well, let me just finish with what CECL does. What CECL does is it says you've got to put up your reserve at the beginning of the loan. You have to estimate where the economy is going, forecast then the amount to put into to your reserve. Our concern with CECL, it doesn't hit monetary policy as much as it hits capital requirements. We think that what this does is it creates the loss reserve to be the equivalent of capital, and so the loss reserve, in our opinion, should get Tier 1 capital treatment under the capital rules.
So you think one of the tools of being a banker today is having a crystal ball?
It's very difficult to predict the future.
That would seem to be the approach. Thank you very much. My time's expired.
Gentleman's time has expired. The chair now recognizes the ranking member of the Financial Institutions Subcommittee, Mr. Clay from Missouri.
Thank you, Mr. Chairman. And Dr. Sacchetti, as you know, the Dodd-Frank Act, among other things, significantly enhanced the macro-prudential responsibilities of the Federal Reserve. In testimony by former Vice Chairman Donald Cohn before this committee back in 2009, Vice Chairman Cohn wrote, and I quote, "The Federal Reserve's monetary policy objectives are closely aligned with those of minimizing systemic risk. To the extent that the proposed new regulatory framework would contribute to greater financial stability, it should improve the ability of monetary policy to achieve maximum employment and stable prices. Do you agree with Dr. Cohn's assessment?
Excuse me. Yes,
Your
I
mic.
do. Yes. Yeah, thank you. I do agree with his assessment. I think that this is true for several reasons. The first one is that financial stability is necessarily the basis for stability in the entire economic system. And so if it's the case that the monetary policy is to achieve its mandated objectives of stable prices and maximum sustainable employment, then financial stability is a foundation for that. The second thing is that I would say is that if it's the case that the financial system becomes unstable and monetary policy needs to react to that financial instability, it takes away from its ability to do its primary job. And I think that what that means is that there's really another set of tools that we need, and this is why it is that many people have focused on trying to generate tools that would ensure financial stability and allow interest rates especially to be the instrument that's used for price stability and maximum sustainable growth.
And if you had the Federal Reserve and its leadership in one of your courses at the university, what grade would you give them for the past 4 or 5 years? How have they performed?
Well, I think they've performed extremely well. I think, they would, you have to take into account that they did it in real time. Maybe in hindsight, we could give them an A-, but if we had to grade them along the way, we would give them an A.
And Mr. Chair, that's a pretty good grade from what I know about school and educating people. Let me ask all of the witnesses, in addition to strengthening the capital positions of the nation's banks, can each of you comment on how the collection of a standardized data set from the largest financial institutions in the U.S. is likely to help inform the Fed's various policy-making roles, including its supervisory and monetary policy function? Starting with you, Doctor, in 30 seconds.
Yes, so interesting question. I've actually been pointing to some deficiencies in the data that's being collected and used that I think should be remedied. The most obvious one is that, for example, Fed stress tests are currently based on Y14 and Y9 data, which are pretty irrelevant for stress test purposes. They should be collecting information based on the managerial accounting of the bank, which would allow them to really understand the bank as a business. They don't do that.
Dr. Sacchetti.
I think the Fed is the guardian of financial stability and needs to be able to measure aggregate systemic risk, I think, and to judge how it's distributed in the financial system. And this requires, in my view, access to intermediaries' exposure information, which is more than we're getting right now. All we have is accounting of assets and liabilities, primarily in some derivatives. The degree to which they're going to be able to transmit shocks, so we need to be able to create network models of how banks are related to each other. This is extremely detailed, and I think it would be very valuable.
Thank you. And Mr. Savan, how would data collection?
Yes, as Professor Calamares indicates, the Fed stress tests today are based on FRY14 data that is collected, and we've got some concerns about the manner in which, while the Fed and the FSR have had a nice dialogue on the manner in which it's collected, we do have some concerns that the monthly reports are not really needed, and that institutions need some additional time to implement changes in those reporting requirements. We'd also like to see the release of some of that data on an aggregated basis.
Thank you. My time is up. I yield back.
The gentleman's time has expired. The chair recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Chairman. Mr. Savan, in your testimony, you brought up some of the challenges associated with the supplementary leverage ratio, or SLR, and how it's calculated. I share your concerns about this problem, and I've introduced legislation, H.R. 2121, the Pension, Endowment, and Mutual Fund Access to Banking Act, to address this issue for custody banks. Many members of this committee are co-sponsors of this bill. In your testimony, you wrote, quote, banking regulators should revise the calculation of the supplementary leverage ratio to exclude risk-free assets from the calculation of a company's total assets for purposes of the ratio. This would include reserves held at the Federal Reserve, cash, and Treasury securities. As you may know, the Treasury Department's recent report on banks and credit unions also endorsed this idea. Governor Powell and Chair Yellen have also expressed openness to this concept. Why do you believe that excluding risk-free assets like cash held at central banks from SLR makes sense?
Well, first of all, FSR supports your legislation and would like to see it expanded to cover all types of banks, not just custody banks, because we do think it makes sense. It would free up some assets that could then be put to more productive use. These are risk-free assets that, in our opinion, do not need to be counted as part of the leverage ratio.
Is there a specific impact for custody banks, though, with respect to this?
Well, custody banks do pose a special issue for custody banks because that's the very nature of those institutions. They're holding a lot of deposits, and so they place them at the Fed for security purposes.
Dr. Keller-Maris, as you know, Professor Cicchetti takes a very different view of the extent and benefits of interaction between monetary policy and supervisory and regulatory functions at the central bank. In his testimony, he writes that, quote, a supervisory function is essential for effective and efficient execution of core central bank functions, close quote. However, in your testimony, you assert, quote, there is no evidence of any synergy between monetary and regulatory policy, close quote. Why do you take a different view from the professor?
Again, I think language is very important. People often confound the informational or examination with the regulatory role. Regulation is setting the rules. There's absolutely no connection between making law and doing monetary policy. There is a lot of connection between having an ongoing access to examination, to participating in examinations. Again, this was exactly the distinction that was made very clear in the 2008 Treasury White Paper, and I support that distinction. So I think that there's a little bit of confounding of language here.
If I could go back to Mr. Savan, in your testimony you suggested that an assessment of the impact of the current expected credit loss, or CECL, accounting standard on lending and economic growth should be conducted. What impacts do you anticipate as this standard is implemented?
Well, as I mentioned, what the new standard requires institutions to forecast forward where the economy may go and set up a reserve. And needless to say, that becomes much more difficult when you get into longer-term loans, such as a 30-year mortgage. So we're concerned that it could have an impact in causing institutions to make fewer mortgage loans or maybe fewer small business loans. We think one way to offset this is to give institutions credit for this reserve as part of capital.
If I could go back to Dr. Keller-Maris, I just didn't jump out at me from your testimony, but I'm curious about it, and that has to do with the Fed's balance sheet, which is frankly a consequence of the Fed's unconventional monetary policy. Does that balance sheet raise any conflict of interest with respect to its regulatory side of work, and how?
Yes. There are multiple conflicts of interest that have come from the new Fed powers that the Fed has taken on in the last several years. One obvious one that's actually related to the supplementary leverage requirement is that the Fed has become a competitor in the repo market. And it was, in fact, a strange coincidence that the supplementary leverage requirement rule was passed at the exact same time that the Fed entered, which applied to repos, was passed at exactly the same time that the Fed became a competitor in that market. And the Fed profited from that rule. Now, I'm not saying that the Fed did it only to profit, but there is no question that there was a clear conflict of interest.
Does that have anything to do with the nature of the assets in the Fed's balance sheet, treasuries and GSEs?
Well, this has to do with the repo function that the Fed has entered. Now, with respect to the assets, there's a different conflict.
What is that?
And that is, well, mortgage-backed securities that the Fed is holding. As you raise interest rates, the Fed will experience If it sells those securities, it will experience capital losses, which have political consequences for the Fed through their ramifications for the Fed's contribution to the budget deficit. They're extremely worried about that. So that could actually keep them from selling off mortgage-backed securities as quickly as they might otherwise. So these are the reasons why it's good to have a monetary authority that's not doing fiscal or regulatory policy.
back.
Gentleman's time has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott, for a word before his time begins.
Sure. Thank you very much. I, too, want to join with my Republican colleagues and certainly from this side of the aisle in wishing a speedy recovery to our good friend, Congressman Loudermilk. Congressman Loudermilk, as we know, was in a car accident. The car flipped over twice or three times. He was en route up from an accident occurred near Knoxville, Tennessee, and they've been flown back to Atlanta for further medical treatment. So we'll get a report on that. And this is just the second time in a matter of a short period of time that very near-death incidents have happened. As we recall, he was there on the ball field when our Republican colleague Steve Calais was shot. So I just ask everybody that we join in a prayer for him and wish him a very speedy recovery. And thank you for giving me that time.
Thank you.
Barry Loudermilk and I not only shared.
Love to associate myself with the comments of both members on both sides of the aisle. You know, make it part of the record that we are prayerful during this hearing.
Thank you very much. What I wanted to say was, in addition, it's very important that Barry Loudermilk and I not only serve Georgia together, but we share counties together. We share Cobb County together. And so we work very closely on very important issues for our joint constituencies. Thank you, Mr. Chairman. I've been sitting here listening to this debate, and I called to my mind the great words of, we had many founding fathers, and none more valuable or greater than the great Alexander Hamilton. And it was Hamilton who said that a strong, centralized national banking system shines at its most brilliance in a time of national crisis. And that's what happened when we suffered the Wall Street bailout situation. And we were very fortunate to have that strong national banking system there. And we responded by establishing Dodd-Frank. And in that, we were able, because we had, which was represented by the Federal Reserve, the apparatus there. And we put stress testing there. And it surprises me that some of my Republican colleagues might not be as mindful of how that benefited us. So, Dr. Crescetti, what do you make of all this? It's my understanding that the Federal Reserve is not only doing a great job with stress testing, but it's because of that our banking system is flourishing now.
Yes, thank you. Let me just start. Your colleague, Congressman Clay, asked me to grade the Federal Reserve only over the last 4 or 5 years. If I were to grade them from 2007, 2008, 2009, I would have given them an A+. So I think and that's not unrelated to your question, because stress tests grew out of the crisis. Stress tests came in the winter and spring of 2009 when the banking system was on the verge of collapse. And what happened was that by stress testing the banks, what the Federal Reserve did was it made everybody more confident that those banks were healthy.
Yeah.
And so I think that it's absolutely essential. Stress testing, which we discovered then by accident, essentially, as a crisis management tool, I think has now become the most important crisis mitigation tool and the tool that we use to ensure the resilience of the financial system more broadly.
Yeah, and Hamilton went on to say that the greatness of this system is that it has the power, it has the authority, and is free from persuasive, divisive politics. And that's why it's so important to have this away from the regular appropriations process for their funding. Now, my staff tells me that the Fed has hundreds of PhD economists who constantly are combing over data so that talented folks like Ms. Yellen can make informed decisions, and her predecessors and people will follow her. So let me ask you about this idea of how important it is to keep the Fed independent, away from what Hamilton refers to as this political persuasiveness and division.
Well, I think it's absolutely essential. I think what's essential is that that monetary policy and supervision both be done by people that can have long horizons, that they not be under the influence of short-term political pressures or those of constituencies that would want them to behave differently from what is in the long-term interest. My view of this is that if we are to minimize the cost to taxpayers in the long run, we need to make them independent, accountable to all of you, surely, for meeting their objectives, but independent in terms of their daily actions and in terms of the budgets to get their work done.
Right, and you mentioned the key word. It is who determines their budget, who determines their money. So, as the guy said in the great movie, follow the money. That's what determines your power and authority. And I thank you for your comments there and how important it is to keep the funding in an independent way. Thank you, sir.
Thank you.
Gentleman's time has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. Thank each of you for joining us today. Just a comment in reference to my good friend Mr. Scott's perspective on the net effect of the regulatory policy from the Fed and as a result of the Dodd-Frank bill. In North Carolina, we've lost 50% of our banks since 2010 because of the compliance requirements. And of course, that's resulted in less capital and credit for small business. It is so important for our economy. Mr. Savon, the VOCA rule, with its immense complexities, ensures full employment, it appears to me, for the Washington lawyers and consultants and bureaucrats, but it continues to really harm others who are in small and medium-sized companies that are unable to expand their businesses. In your testimony, you stated that, and suggested that the VOCA rule would, quote, impair liquidity in the nation's capital markets, which as a consequence would force businesses to face higher borrowing costs, resulting in less economic activity and translating into fewer jobs. Having said that, do you believe this still to be a valid concern? And specifically, what actions should Congress take to remedy this situation and help these businesses ensure full economic opportunity?
Thank you, Congressman. When the rule was contemplated, there were concerns that it could have some impact on liquidity, and recent studies are starting to bear that out. In fact, studies by the Federal Reserve itself have started to bear that out. So we recommend that the rule be revisited We're not alone in making this recommendation. The agencies themselves and the Treasury Department are starting to acknowledge that it is overly complex and there could be some improvements. In my own practice, I have helped a number of mid-sized banks develop their compliance programs for this rule. And what that exercise turns out to be is a demonstration that they're not engaged in proprietary trading. They're not making investments, so it becomes proving the negative. Clearly, there's a category of institutions that this rule should not apply to. The scope of the prohibitions could be narrowed. The compliance requirements could be more streamlined.
What role then should the Fed play in trying to implement any changes?
Well, the Fed is one of the 5 agencies that's responsible for writing this rule. So the Fed could coordinate with the other agencies in helping to streamline and address these issues.
Thank you. Mr. Calamaris, as you are well aware, the Fed was established more than 100 years ago. According to the Board of Governors website, it says that it was established to provide a safer, more flexible, and more stable monetary and financial system. Yet the research suggests that the U.S. has been the most financially unstable developed economy in the world for 2 centuries. As you know, Dr. Calamaris, Dodd-Frank gave the Fed a prominent role in the prudential regulation of our financial system. Should we believe that this time is different? That we finally found the optimal regulatory structure for our crisis-prone financial system? Or is the new regulatory structure the same as the old one, fragile by design?
I don't think that it's very promising looking forward. I agree with my colleagues here who've said the banking system right now is more stable than it was before. That's not really the interesting question. The interesting question is, when we go through the next unstable period, will these regulations work better than the last ones? And I think it's pretty clear that they won't. I've just completed a book that I know all of you have because I made sure you all got a copy, explaining why I don't think it's going to work. And that also underlines my point that this shouldn't just be a discussion about deregulation. This should be a discussion about strengthening regulations that are not credible. And I would say that the implementation of Dodd-Frank is not very credible. We're already seeing mortgage markets looking very similar to what they were doing in the late 1990s and early 2000s. That's the result of government decisions, FHA decisions, FHFA decisions. These were political decisions. They're putting us back into the same direction. We saw the QM and the QRM standard, because they were given to the regulatory agencies to decide the details of, we saw those being whittled away. And we saw, of course, what Barney Frank has bemoaned as the loophole that ate the standard. So I think that we have a lot of reason not to be very confident.
Thank you. My time has unfortunately expired.
Sorry if I went on.
Thank you very much. No, appreciate your testimony.
The time of the gentleman has expired. The chair recognizes the gentleman from Illinois, Mr. Foster.
Thank you, Mr. Chairman, and thank you to our witnesses. There have been 2 great financial crises, I guess, in our lifetime, the 2008 crisis, also the savings and loan crisis. In which one of these did the taxpayer have to write a bigger check? Oh, anyone who wants to handle it, just roughly.
The first one? The
First one,
savings
yeah,
and
it's my
loan
impression
crisis.
that it was the check was about 2%
it's
of GDP, right?
A little bit
Whereas-
more, yeah.
A
But
little bit more,
it's
right.
a tough one, because if you're asking, write a check, that's a complicated question to answer. The total exposure of the taxpayer, potential loss exposure, was greater in the second crisis, but the actual
Potential, but the actual losses
Yeah.
were higher. I think they were,
Yeah.
the nominal losses at least were near zero.
I
TARP
agree
was
with that,
repaid.
yes.
And so I think that's a significant point. And I'm trying to get back to your point, Dr. Chetty, about, what we're hearing here is that the solution to our problems is to subject regulators to the appropriation process, which is something you pointed out had been done to the regulators of the S&L. And we're also talking about the crosstalk between monetary policy and regulation. And it's my sort of simple-minded understanding of the S&L crisis is it was a bunch of smaller institutions getting on the wrong side of an interest rate bet. And then when the Fed made a big move in monetary policy, they were in big trouble. And it was the lack of any communication between between the regulators and understanding what sort of stress that would put their regulated institutions under when the Fed made a big interest rate move, that actually was the driving mechanism. Of course, it spiraled into fraud and everything else. But I was just wondering, is that a fair evaluation of how useful subjecting regulators to the appropriations is?
Yeah, I mean, I believe that it is, and let me just say that I think that you have exactly the right pathology in mind, which is to say that interest rate increases generally harm bank profitability and bank equity positions. And it's important, therefore, for the people who are contemplating those increases to understand what their overall impact is likely to be, and for them they're going to be in a best position also to ensure that when they do raise interest rates, which they will ultimately have to do under circumstances in order to ensure that prices remain stable and that growth remains stable, that they understand what the consequences of those actions are going to be at a relatively detailed level.
Yeah, and that had there been better communication between regulators and monetary policy, actually would have been our best shot at preventing that largest taxpayer bailout of history in the savings and loan crisis.
Well, I think that I'm not sure I would go quite that far, but I do believe that having that what was missing, especially in the last crisis, was having someone who was clearly responsible for the financial system as a whole, and especially for the largest, say, 3 or 4 dozen financial intermediaries that are systemic, that where any one of them failing had large consequences for the system as a whole.
And thank you. And Dr. Kalmars, you've written extensively on contingent capital, which you're aware I'm a big fan of as a mechanism, a market-based mechanism to make sure that it's not the taxpayer that's left holding the bag. Could you just say a little bit about what you think the experience has been internationally with using these and what the prospects should be for avoiding future bank bailouts?
Very quickly, the right instrument that I've been proposing has never been created yet. What we do know, however, is that the demand for contingent capital type instruments has turned out to be very high by ultimate investors, and so I think that's the evidence that's the most promising. What we also, though, know is that we've created this total loss absorbing capital concept, which the contingent capital could be used now in the context of that concept as the form required at the bank holding company. But it has to be required in a much larger amount than is currently required, than is currently present. So I think we have a lot of inadequacies that the contingent capital could help.
But there's also an important difference there that the TLAC triggers at insolvency, not violation of capital requirements.
Exactly.
So a market-based instrument that warns the banks 2 steps back from the cliff, rather than at the point of insolvency, has a real merit, and so.
That's exactly right, and that's the essence of why this is so important, because I don't have confidence in the FDIC's ability to resolve these very large institutions, despite what they say under Title II. So we have to keep them far away from that point, so we don't test that.
Well, thank you, and keep on this subject. I'm a big fan.
The gentleman's time has expired. The chair now recognizes the gentleman from Colorado, Mr. Tipton.
Thank you, Mr. Chairman, and thank you, panel, for taking the time to be here. Mr. Savan, I'd like to return back to a question, maybe get a little more comment from you that Chairman Luetkemeyer had raised in regards to rules and regulations and the overlaps that we've had. We'd sent a letter, actually, to Secretary Mnuchin, 31 members of this committee. It asked him in his capacity regarding the FSOC to be able to address rule and regulation overlap, to be able to streamline some of those processes. We've had Chair Yellen before this committee on numerous occasions, also noting that regulatory policy does have a trickle-down effect that's impacting smaller institutions as well. Can you maybe speak a little bit to some of the costs that are going to be associated with having that duplicative, overlapping regulatory policy and how that impacts people literally at home?
Yes, thank you. It is a major issue for the members of the roundtable, which are larger institutions, but you're absolutely correct that there's a trickle-down effect. Even though rules may be tailored, they're often applied to institutions below the specific rule. Some examples. Today, institutions have to prepare resolution plans for a holding company. They also have to prepare resolution plans at the individual bank level. Some recovery planning is required by some regulators, which is a plan that, before you get into a failing situation. There are duplicating requirements on risk management standards that the OCC and the Fed have put out. So there are examples of instances where we're quite concerned that the agencies are not coordinating as much as they should be. FSOC could play a role here as an organization where all these agencies do sit, and maybe in the new administration it will play more of a coordinating role.
Thanks. I appreciate that. I think that's a lot of the challenge, particularly at the community bank level, that we're seeing, that our smaller institutions, best practices. It may not be theoretically applicable to you, but indeed it becomes applicable to you, and that tends to flow down the list. And I just had an opportunity during the August break to be able to visit with a lot of our community banks, and I think a number of them would actually be applauding you when you're saying make the loan loss reserve Tier 1 capital. We used to think of this as something separate and unto itself to be able to deal with it, but it's now impacting that ability really to be able to make some loans and to be able to help our folks at home to be able to grow the economy. Would you maybe talk a little bit more? I thought it was interesting when you were talking about some of the modeling on the stress tests, to be able to reveal some more information so that our banks, we understand we don't want anybody to be able to game the system. But would you maybe speak to that just a bit more?
Yeah, I would agree with others on the panel that stress testing is one of the more important reforms that has been put in place since the crisis. And in fact, if you look at the results of the latest stress tests, they do demonstrate that large institutions could survive a crisis of worse magnitude than we went through in 2008. The problem that we see with the manner in which the stress tests are operated today, though, is there's the models that the board maintains are not shared, they're not transparent with the industry. So you have bankers that are trying to estimate what the board's model may show and modifying their loan activity to try to meet that standard, whereas that may not be the most appropriate manner in which they should be engaging in their particular community, given their risk profile and the market in which they operate. So we think there's a little disconnect between the lack of transparency under the current structure.
Thank you. And Dr. Calamaris, I'd like to maybe just return a little bit to the ability to be able to use a little bit of the power of the purse, the appropriations process, in terms of some questions that have been asked that in terms of making the Fed actually more accountable. When we look at 15% of the U.S. mortgage market securities are currently held in the Fed, is that going to impact some of theirs? Is there an appropriate way, or would using that monetary policy be negative?
Well, I'm very worried about the Fed keeping those on its balance sheet, and I support a recommendation, which I also have made a long time ago, that Charles Plosser has also been pushing for us to engage in a swap between the Treasury and the Fed to swap those for Treasury securities so that we get the Fed out of the mortgage business. And that's also an inappropriate fiscal intervention. The Fed is clearly intending to affect the relative cost of particular financial instruments. That is not monetary policy.
Thank you much. Mr. Chairman, time's expired. Yield back.
The gentleman yields back, and we are playing musical chairman here today. And so I'll be chairing for a little bit the rest of the committee hearing. So with that, we also have an important moment here. The gentleman from Indiana is going to be recognized to question for 5 minutes, but understand it's a very, very important day in his life. Happy birthday. Is that correct, sir?
Yeah, that is correct. Thank you. Very, very important, maybe overstated.
Very important, very important.
Happy to make another milestone. So.
Older and wiser, yeah, there we go. Gentleman's recognized for 5 minutes.
Well, good afternoon, gentlemen. I really appreciate you taking the opportunity to come talk to us today. And so far, it has proven enthralling, I can tell you. And for the dozens of my constituents back home watching this, it is indeed enthralling for them, I'm sure, right? But I wanted to come back to something because I've heard it implied or even explicitly stated a few times that the lack of a crisis in the last 9 years is somehow evidence that this extra regulatory burden will forever and always keep us safe from a crisis, instead of some recognition that, by the same logic, the fact that we had regulators and regulations before the last crisis seems to be some evidence that regulation, and especially by edict out of D.C., instead of enabling and empowering lenders to be able to pursue their own business models, it might in fact be one of the root causes for some of the instability. And I'd love it if Dr. Calamaris would comment on that.
There are so many pieces to it. Of course, I wrote a book that went through that in some detail. But you know, it's important to remember that as we're worried about too big to fail institutions, that we're running up inordinate risks having to do with the mortgage market, that the Fed was the institution that, first of all, was managing the merger process that created too big to fail institutions.
Right.
And it was the Fed that was also managing the Prudential regulatory process that decided whether they had adequate capital. And I would say the Fed was extremely politicized.
Right.
And that its extreme politicization led it to approve of mergers in a way that created mortgage risk and then therefore could not set capital requirements that would have created adequate capital. So that was, to my way of thinking, probably the single best example of the kinds of problems that come from a politicized regulator that's a central bank.
And one of the deep challenges I have, and again, my statistics is rusty, but the use of the counterfactual here, somehow saying because we've not had a crisis that we're okay. But what we haven't talked about is the tremendous cost on the U.S. economy of the misallocation of capital across it because of government intervention, government distortion, and excessively burdensome government regulation, which continues to misallocate capital and not get it in the hands of those that could most productively use it. And the economy has suffered because of that. People back home have suffered because of that. And I'd love it if you'd comment a little bit on that.
Well, the most obvious area has been small business lending, especially because small banks have a lot to do with small business lending, and small banks have been really hit a lot by the overhead costs of the regulatory burden. That's one part of it.
And what if those just, what I hear from my small bankers in the community is what they say is we've been essentially forced to combine because the regulatory burden is so heavy and that fixed cost is so heavy. We've got to amortize that over more and more customers, more and more loans, more and more products. And so we've combined and gotten larger, and thus they find themselves less capable of serving the communities and find themselves more and more, in their feeling, in servitude of a bureaucracy in D.C. instead of focusing on enabling and empowering their customers.
It shows in all the statistics that are, you know, I've quoted in my various work. I mean, one thing that I would also point out is we're going to great lengths through a variety of measures to push mortgages rather than small business lending as what small banks do.
Right.
And so it's not just that small banks have been hurt, it's also that if we actually required banks to be more diversified across their lending, we would help small businesses quite a lot.
Indeed. And Mr. Savon, I wanted to ask you specifically about a bill that I've recently introduced. And this bill, H.R. 3179, the Transparency and Accountability for Business Standards Act, is really simple. It's about harmonizing regulation across jurisdictions. And the fact is that the United States has gold-plated many of the standards coming back from overseas. And I wanted, if you could talk a little bit about the global competitiveness of U.S. institutions in the face of a heavier regulatory burden here at home than others may face in other jurisdictions.
Yeah, thank you, Congressman. It is one of the issues highlighted in our testimony. We do think that the layering on of additional requirements for the larger U.S. institutions does raise competitive issues for them in global markets. And the legislation that you've introduced provides for the regulators to do a cost-benefit analysis before imposing that kind of a standard. We strongly support that. We think the idea of cost-benefit analysis makes sense there as well as in other regulations that the agencies are proposing.
So the net is, when I think about the regulatory burden in this country, the misallocation of capital is costing opportunities for higher economic growth, for people to realize meaningful wages. And then in addition, that regulatory burden is costing U.S. companies competitiveness around the world to be able to export some of the great things that we've developed here to other countries. And with that, I will yield back, sir.
Gentleman's time has expired. With that, we go to the gentleman from Minnesota. Mr. Emmer is recognized for 5 minutes.
Thank you very much, and thanks to the panel for being here. I'm over here. I just don't even know where to start, so much as this has been covered. It's a very interesting discussion. But I think I want to start with Dr. Kalanis. You had talked about one of the reforms being budgeting authority, having more oversight on budgeting authority. What about the argument that we hear constantly, and I think Dr. Cicchetti made this argument at some point, that this would impact the Federal Reserve's independence, putting their budget under the supervision of Congress, for instance? How would you respond to that?
So I think the important first step is to ask, when we talk about Fed independence, what are we talking about? Okay, so independence in the literature for decades has always meant independent of special interest pressures, independent of short-term pressures coming from the administration. It has never, ever meant that laws that the Fed administers should be made independently of the United States Congress. So I just want to be clear, when I use the word independence, I don't think that it's consistent with our Constitution to think that the Fed should be writing regulations that are not overseen by the U.S. Congress. I think that's a very radical and new idea that seems to me to be just wrong. So now the question then is, well, what's the role of budgetary discipline? Congress, under the Constitution, is the only agency, is the only institution that's supposed to be sending funds for whatever purpose in the government. So I don't really understand how you can read the Constitution and find this authority for the Fed to have a blank check to spend money any way it wants.
Dr. Cicchetti, thank you. Dr. Cicchetti, you had testified, and I wrote it down early this afternoon, that you need to have an objective, and then there need to be guidelines on how to get to that objective. How is that different from having a rule in place, which is in effect a guideline? I think the proposal from this Congress or this committee has been one of the proposals to put a rule in place so that at least people in the public know what to expect, but it doesn't have to be followed. And if it's not followed, then it would require an explanation as to why we're not following. How is that different?
So sorry, will the gentleman yield for just a second?
Absolutely.
As the author of the former Reform Act, and I know Chairman Barr's been working on this, we actually had said that the Fed could make up their own guideline and just have it out there and then explain when they were going to deviate from that. So that was not even anything that we on this panel or the House or the Senate or anybody else would put forward. It would actually be a guideline created by the Fed and measure themselves. So I yield back.
And great context. How is that different from what you said?
So what I was trying to say is that I view the job of the Congress as to set the objectives and to hold the Federal Reserve accountable for meeting those objectives. I do not believe that it is worthwhile for the Congress to be involved directly in setting policy.
But actually, to interrupt, because we're going to run out of time, that's exactly what my colleague just said that they were proposing, is go ahead and set the objective, you do the policy, so all of us know what it is, and then you've got the guidelines, the policy guidelines, and you explain. It sounds to me, sir, as though we actually agree on this. I got to go back with the limited time I have left to Dr. Kalonis, because I have some concerns with this conflict of interest and the politicizing of the Federal Reserve. We have lost so many community banks, family-owned community banks and credit unions over the last 7 years since Dodd-Frank was in existence. And in fact, it started even before that, but it's been accelerated in the last 7 years. And it seems as though, looking at it and reading your testimony, listening to you here today, and perhaps your colleague might weigh in as well, in order to exist with this regulatory function and the monetary policy function, you have to have a lot of resources in order to exist, and we are not creating new banks. Is there a favoritism towards the larger institutions?
I just have a new volume coming out that I'm editing on this, and some of the rules are hitting the large institutions, of course. Some of the rules are hitting the small institutions. The main problem with the small institutions is how do you spread the overhead from having to comply with these things over a small balance sheet? And I think that's why it just becomes existential for them.
Gentleman's time has expired. With that, we go to the gentleman from Arkansas. Mr. Hill is recognized for 5 minutes.
I thank the chairman, thank both chairmen for this interesting topic to continue our exploration of the Fed and the role of the Fed, both in monetary policy and in regulatory policy. And I'm sorry I've been in and out today. It's one of those days on Capitol Hill. I'd like to talk and follow up on my friend from Indiana's comments about misallocation of capital and get your views, so just from a little different perspective. Obviously, market prices provide a lot of information to market participants, and you've had the Fed really over the last few years be unprecedented in sustained decline of zero interest rates, plus doubling down with QE1, QE2, QE3. And we have the third most expensive S&P 500 now in history. Of only 1997 to 01 and 1929 exceed the price earnings multiple on the S&P 500 right now. And we have historically low cap rates for long-tailed commercial real estate properties, for example. And I think at the last count, something like $13 trillion of sovereign debt is at a negative yield. So these are clearly unprecedented times. But one of the key components of that was back in 2012, the Fed established an inflation target of 2%, which we've not hit. And I wonder if that calls into question whether they should even have set such a target if they can't hit it. I think Gary Schilling said I'm paraphrasing, if you can't hit a target, maybe we need to question our authority to even try to do that. So I'm interested in your views on that inflation target. Should that be maintained, or should we, as we normalize the balance sheet or attempt to, also let that go by the wayside as a test for the last years? Each of you, if you'd comment on that, please.
I would have preferred a 1% target rather than a 2% target, which is the one Alan Greenspan, as I read it, suggested in 2006. But now that they've stated that the 2% target, I think it's important that it not be subject to change. I think that they need to stick with it because they've now said that that's their long-run target. That should be subject, of course, to your approval, but I think that it's a good idea to stick with it. I also don't agree with people who say the Fed has undershot its target because this is a long-run target. It's not clear yet whether being at 1.5% for current inflation means that they're pursuing policies that are long-run below that long-run below the target. So I don't think that we want to be too critical of the Fed for coming in at 1.5% rather than at 2%.
Well, and I just want to add one nuance to that. I mean, at 1.7%, should we just declare victory, and say we've hit 2%, if it's going to not let us take other policy decisions in the monetary policy arena surrounding the balance sheet that maybe we should, because it is just one factor considered, not the only factor.
So just very quickly, monetary policy remains accommodative. In real English, what that means is monetary policy is still pushing toward going to a higher rate of price growth. And that is appropriate given that the Fed has a 2% objective. I think it should be less accommodative than it is. So I think the Fed is basically doing behavior that's so far consistent with a 2% policy objective, and I think that we shouldn't beat them up too much.
I agree with my esteemed colleague, and that 2% is now that you have it, I think you have to keep it. If you start changing it, then everybody's going to wonder when you're going to change it. And the most important thing, I think, for all of us and for individuals, for small businesses, for households, for investors, is that they be able to have some security in what inflation will be over the long run. And in this, I think Dr. Calamir's and I completely agree that these modest deviations over relatively short periods of time are not a problem.
Mr. Sullivan. Quickly, sir.
On monetary policy, the members of the FSR will operate in any interest rate environment.
Thank you, Mr. Chairman. I'll yield back. Gentleman's time has expired. With that, we go to the gentleman from California, Mr. Royce, is recognized for 5 minutes.
Well, thank you very much, Mr. Chairman. Dr. Calamiris, as you may know, I've spent a lot of time concerned about the drug of leverage, as you refer to it. In fact, when the House considered GSE reform back in legislation in 2005, I introduced an amendment to give the regulator the authority to curtail the systemic risk posed by Fannie and Freddie's portfolio. The regulator would have had the ability to deleverage those portfolios. That amendment was defeated by a large margin, leaving the underlying legislation incapable of curtailing the risk exposure from these portfolios. The opponents of my amendment, on both sides of the aisle, claimed Fannie and Freddie posed no threat to the financial markets, and that systemic risk was, in one of these debates I remember here, a theoretical term. In reality, the opposition was looking to preserve the status quo. They were looking to allow Fannie and Freddie to grow at a very alarming rate without any meaningful constraints, and I would add, without any oversight from this institution. You've said we need the political courage to give up the drug. Do you think we have learned from that crisis? Have we brought transparency to the GSEs and the Federal Reserve and the role they play in terms of subsidizing our housing markets? Do people really understand that, or is the moral hazard that I pointed out then still in play today?
It's gotten worse. So let me remind you that as soon as Mr. DeMarco was replaced by Mr. Watt, one of the first things Mr. Watt did was to lower the down payment requirements for GSE-eligible mortgages from 5% to 3%. 5% is way too low. 3% is unbelievably low. The FHA also cut insurance premium. Did the FSOC, who's supposed to be looking for systemic risk, have they ever used the word mortgage or real estate in any of their discussions? Almost none. Why? The Secretary of the Treasury is the head of the FSOC. So why would the administration that appointed Mr. Watt then also say that Mr. Watt just created risk? They wouldn't, right? So the problem is the FSOC is politicized and not going to be honest about mortgage risk. And it's currently a threat. It's going to get worse.
Let me ask Mr. Savan a question, because you're someone who has opined on insurance regulation for many years. Could you take a minute or two to describe how we ended up where we are today, because this is no longer a discussion about state versus federal regulation. It is now a discussion about layered regulation. That's the difference. The Federal Reserve now plays a pronounced role in this regulation, and I can think of some of the possible positives from the outcome. You could argue that maybe now on the monetary policy side, the Fed better understands the impact prolonged low interest rates have on life insurers trying to plan for the long term. That's a positive. But on the regulatory side, it is unclear what the proper role for the Fed is in the future. So I offer you the floor here with the remaining minutes.
One of the major changes in the Dodd-Frank Act was to give the Fed regulatory and supervisory authority over a number of insurance companies. In fairness to them, I think they have been moving slowly in the manner in which they've been exercising that authority. On the other hand, as I note in my testimony, we think it's very important for the agency to appreciate the distinction between the business of insurance and the business of banking. And some of the supervisory policy statements that they have put out have been more aimed at banking than recognizing the distinct issues that an insurance company faces. The most recent action that they took last year was to propose capital standards for the insurers that they regulate. They proposed two alternative standards, one called a consolidated approach for the very largest insurers that they regulate, another called a building block approach for the savings and loan holding companies that are owned by insurance companies. The building block approach is based upon state insurance regulation. And so it's our strong view that as the Fed moves forward in regulating capital requirements for the insurers that it regulates, it doesn't layer on yet a new type of capital requirement, but look to what the states have done and build on this building block approach for capital requirements for insurance companies.
Thank you very much, and I thank you again, Mr. Chairman. I thank our witnesses.
Gentleman's time has expired. We have a situation where we are truly enthralled by your expertise today, and we've got another round of testimony or another round of questions that we'd like to ask if you guys have got some time. We would like to impose on you to be able to do that, or you guys got some other places to go here shortly? No? Okay. Otherwise, we'd like to start a second round, and we'll start with the gentleman who's the chairman of the Oversight Subcommittee, gentleman from Kentucky, Mr. Barr.
Thank you, thank you, Mr. Chairman, and I appreciate the indulgence of our witnesses. We appreciate the very interesting exchange of ideas here today, and what I've heard from all of the witnesses is a general agreement that Fed independence, a Fed free from politicization, is a goal that we share. But I think a strong argument can be made that the Fed's aggressive implementation of the Dodd-Frank law, that their zealous supervisory activities, their overregulation, arguably, that has in fact diminished economic growth, that has undermined credit availability and capital formation, and that process of being engaged in the regulatory supervisory process has actually induced the Fed to pursue a radically unconventional and accommodative monetary policy to offset the growth-destroying effects of their regulatory policies. And that obviously, that monetary policy has distorted financial asset values. It's discouraged financial capital from freely engaging in its most promising opportunities. And witnesses in this committee, in this subcommittee, have expressed concern about the Fed's balance sheet stepping out of what is necessary for the conduct of monetary policy and obviously into unprecedented, unchartered credit policy. So the point I'm trying to make is that this conduct, I would submit, does not really look like a government agency free of politics. That to me looks like a government agency that is totally politicized. And so I'd invite your feedback on that observation. Yeah, Dr. Calmiris.
I think it's true. It's inevitable. When you get into things like mortgage-backed securities markets and you're making changes in relative interest rates for different financial instruments, that's what we economists call fiscal policy. That's a decision to subsidize some kinds of uses of funds at the expense of others. So when you get engaged in that, just like any political institution, you become a political institution and you become a lightning rod for influence. So I don't think it's, this is one of the reasons why monetary policy just has to stay away from those kinds of things.
And just to follow up your answer there, and I want to hear from the other witnesses on that, but I think you've made the point, Dr. Calmiris, that as an owner of over 15% of U.S. mortgage market securities, the Fed's monetary policy makers are quite conflicted when it comes to interest rate policy.
That's right. I also just want to say, I think your analysis of the motivation of the Fed is right, that the Fed, having been part of the problem of creating the growth slowdown, has actually tried to do things to try to prop things up. It's not working very well. And Marco DiMaggio, my former colleague, his study found that the only part of QE that really had a positive effect of QE2 and QE3 was the mortgage-backed security part.
And Dr. Cicchetti, I do want to give you an opportunity to respond. And as you respond, could you also address the testimony that you made, that you offered earlier, that the job of the Congress is to set objectives and hold the Fed accountable. But how does Congress hold the Fed accountable on rulemaking if they're completely immune from the meaningful oversight of the appropriations process?
Well, I believe that you can hold them accountable with. Let me start with your first points. I think there are 2 points. First of all, on the mortgages, I think that many people, including me, are uncomfortable with the fact that the Federal Reserve owns so many mortgages, the mortgage-backed securities. But these were purchased. These were purchased as the Fed was trying to support the mortgage market during a collapse. And I think that they will let those run off as soon as they practically can. On the issue of stringent capital requirements, I think it's important to understand that capital requirements facilitate lending. Strong banks lend. Banks that have strong underlying capital positions are lending, and they're doing it now. And I think that that's a very, very important thing that I hope that everybody appreciates. There is an issue which has come up a number of times, which I will comment very briefly on, and that is that I think there's also broad agreement that a $1 trillion bank and a $1 billion bank should not be treated identically. And the question then is, how do you change that treatment?
Yield back.
Gentleman's time has expired. We go to the ranking member of the Financial Institutions Committee, the gentleman from Missouri, Mr. Clay.
Thank you, Mr. Chairman. And Dr. Cicchetti, the outlook of the economy, including whether financial conditions are likely to lead to faster or slower future growth, have a significant impact on both inflation and employment. Given this, can you talk about how the information that the Fed learns through its supervision of the financial system would inform and enhance the Fed's outlook on how it may need to adjust its monetary policy stance in order to achieve its statutory full employment and price stability objectives?
Yes, Congressman, I'd be happy to. The Federal Reserve's interest rate actions operate through the banking system. So it's essential when they set their interest rate to know what it is that the banking system's doing. The information that the Federal Reserve has access to today, prior to making those decisions, includes information about individual borrowers and individual lenders. They know about the size of loans, they know who it is that's doing the borrowing, and they know what the terms are of those loans. They use that information, aggregating it, obviously, in a way that then informs them on how it is they need to set their policy in order to ensure that the easing or tightening of the policy has the desired impact.
And to what extent does the Fed's forecasting function tend to rely on analysis of supervisory data?
Well, I think the answer to that is that we're going to know more and more about that over the next few years. As Dr. Calamiris pointed out, the Federal Reserve, as part of its accountability mechanism, releases transcripts of the Federal Open Market Committee meetings with a 5-year lag. So right now, we don't actually have access to the discussions in the meetings for the past 5 years. But my understanding from speaking to some people inside of the Federal Reserve is that the kind of information that we're describing here now has found its way in that time period because it hasn't been collected in a consolidated and consistent way until the last few years, but that it is now finding its way into those decisions and into those discussions.
Thank you for that. And Dr. Calamaris, considering the performance of the U.S. economy over the last year. Do you consider that the Federal Reserve has made the correct moves as far as being able to lower unemployment and the strong market indicators that we see now? Do you give them any credit for that performance?
Absolutely. As I said, I think we're below our long-run inflation target. I think that according to the Fed's own measures, though, of unemployment, it's been a moving target. So the Fed doesn't really have a very good sense of what the long-term right level of unemployment is, and that's been one of the things we've been learning. So it's been a tough job. I think that qualitatively they've done a fair job. My friend, Mr. Cicchetti, is an easier grader than I am, but I would say that they've done a decent job under a circumstance of extremely uncertainty about the long-run unemployment rate.
Thank you for your response. I would prefer to take a course from Dr. Cicchetti, I think. and with that, Mr. Chair, I yield back.
Gentleman from Missouri yields back the balance of his time. As a gentleman who actually got an A or two in school, we're okay with either one of these guys. I think we can make it work. With that, we go to the gentleman from Indiana, Mr. Hollingsworth, is recognized for 5 minutes.
I really appreciate the testimony again, and thank you for being here. So one of the things that was said a few minutes ago was that strong banks make loans, and I don't doubt that loan growth hasn't been zero, but it certainly hasn't been as robust as it otherwise would be. When we look back at prior recessions and loan growth post-recessions, we have continued to see this one lags back behind by many dozens of statistics and measures, and that's a real challenge. It's a real challenge because capital formation out in, especially where I come from in the heartland, is really poor, and we've got to fix that. So that's one thing that I talk a lot about, which is kind of the wet blanket effect of all of these regulations. The other thing, which isn't talked about as much, but I've been pushing really hard, is the effect on bank balance sheets of these many intrusive regulations. And let me tell you what I think I mean, which is the more and more that we develop a higher and higher regulatory threshold in a variety of different areas, the more and more we force institutions to look more and more similar to each other. By government saying we're going to weight these and not these, we're pushing banks into a corner. And you have to be really careful when you line banks up like that, because you better hope you got everything right, because now you've lined them up to where the moment there is an issue, it is a very quick transmission from institution to other institutions because their balance sheet looks very similar. What I fundamentally believe is that robustness and resiliency are emergent qualities from a system, not qualities that can be demanded by fiat. And so Mr. Savan had talked about this a little bit earlier, and just allowing for a diversity of businesses to exist within the financial landscape and a diversity of business models. And I wondered if you might touch on that again and talk about how maybe a resilient, robust system, one that can withstand shocks, probably derives from that diversity of business models, risks, and profiles.
Yes, thank you. Clearly, the system is stable today, in part because of many of the steps that have been taken by the industry and regulators and Congress. Our view is that we probably have some excess capital and some excess liquidity requirements today that could be put to more productive use and help economic growth.
Right.
And that's the nature of the recommendations that we make in our testimony in terms of adjusting the capital requirements and the liquidity rule and the Volcker rule and the supplemental leverage ratio and so on. I mean, there's quite a number of changes that could be done in a fine-tuning way to help economic growth.
Dr. Calamaris, would you like to comment? And then
I'll just, like a broken record, just point out that it can't possibly be a good thing that, putting aside the largest banks, that the banks throughout our country have about 3/4 of their loans in real estate. Mm-hmm. So when you're asking, are we in a situation that's going to be resilient when all those balance sheets are basically lending to one sector that is very correlated with the business cycle and has a very hard time selling assets during a downturn. How are we dealing with systemic risk? I think it's kind of a joke.
Dr. Caccetti?
Two quick comments. First of all, I think it would be very difficult to disagree with your comment about the necessary need for what I would call a diverse ecology in the financial system in order to ensure its resilience. I think that's absolutely essential, and to the extent that the regulatory environment is overly constraining in certain ways, it will decrease that diversity and reduce the resilience. I would, however, want to comment on the issue of the lending levels. I think that we did not come into the crisis with levels of debt that were sustainable. Right. And so the fact that levels of debt today are lower and that growth rates during the recovery have been lower than those in previous recoveries, I think that is something that we should not be terribly upset about. The distribution of those loans is a separate issue, as my colleague just described, and so I would agree that if all you're doing again is lending to real estate, that's an issue.
Well, I certainly understand that perspective, but back home in Indiana, there are a lot of people that feel like it is something to be upset about, and the lack of loan growth, and especially loan growth to the incremental individual that might be on the bubble of creditworthiness, but is trying to start that business, trying to make a difference, right? Trying to build a better financial future for themselves. To them, the lack of loan growth or credit availability has been a real challenge, and they feel like it's being more and more directed by bureaucrats in a fashion towards others and not towards empowering them across the heartland. So with that, I'll yield back to you.
Gentleman's time has expired. With that, I go to the gentleman from Georgia. Mr. Scott is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Caccetti, it seems to me that some of my Republican friends want to strip the Fed of its supervisory and regulatory functions and leave the Fed, in my opinion, and I want your opinion on this, wouldn't that leave the Fed ill-equipped to be able to judge the conditions of the financial institutions that they're in business to do? Wouldn't it make it very difficult, particularly when the Fed has a role of being the lender of last resort?
I mean, I certainly believe that. The making a loan to a bank, for the central bank to make a loan to a bank, I think is a very important financial stability tool. But at the same time, it's extremely important that the central bank, the Federal Reserve, not make a loan to an insolvent bank.
Right.
You cannot be in the business of lending money to people who are already bankrupt.
Right.
There are many reasons for that. The first one is that that's basically a bailout. The second one is that you're subordinating existing debt holders, because the Federal Reserve is going to require collateral. It's going to come in senior to everybody else that's out there. The second thing you're going to do is you're going to make the cleanup more costly. And the third thing is that if you make loans to bankrupt institutions, what's going to happen is that people are going to come to know that you make loans to bankrupt institutions, and then others are going to assume that if you go for a loan, you're bankrupt, and nobody's going to want to go for a loan, so it's going to be very stigmatizing. So I think that the only way to ensure that the Federal Reserve or any central bank does not make loans to insolvent institutions, to bankrupt institutions, is to have supervisory information, because you need things that are very, very current, and you need people who you can trust providing you with that information.
And it seems to me that they want to take it away from the Fed and put it to some outside entity. What outside entity are they talking about?
Well, I think you'd have to create a new one. I mean, either that or you're going to have to combine the Federal Reserve's supervisory and regulatory authority with an existing agency, and I don't see anyone suggesting that. But I don't see how you could do it.
There are many ways to do it. Let me remind you that in 2009, Senator Dodd, that was his vision of how we should have crafted the Dodd-Frank Act, and I agreed with that. I think we should have gone in that direction. Furthermore, the 2008 Treasury blueprint that I keep referring to specifically made the same distinction. It seems like Professor Cicchetti and I are sort of in agreement, because the key point is you want the lender of last resort and the monetary authority to have continuous, unfettered access to all information and to participate actively in the examination process, that aspect of supervision. But you don't need them to be deciding who gets to merge and who doesn't. You don't need them to be setting laws down. It's a different function.
But it just seems to me that if you're the lender of last resort, and that power and authority rests with you, you are the fulcrum of the welfare of the entire economy. But if you take away that ability to give it to an outside source, that really is a mystery. You just can't pluck it out the air here and give it to it. I mean, I would think it would be a devastating turbulence to our whole economy.
I think that I'm not the historian that Dr. Calamiris is, but I will say that the Federal Reserve was started in 1914 by the Congress in order to actually do this.
Right.
And so it's hard for me to see how you would organize this in a different way.
Yeah, let me just ask you on the appropriation process, Mr. Crucetti. What will subjecting the Fed's non-monetary functions to the appropriations process, in your opinion, do to the economy?
Well, I think it would be bad, but I think you've run out of time.
You did say
it would be bad. I think it would not serve us well.
All right, thank you.
Gentleman's time has expired. With that, we go to the gentleman from Illinois. Mr. Foster is recognized for 5 minutes.
Oh, thank you again. Let's see, one of the issues in the inflation target is whether we actually measure inflation properly. You know, there's this, I guess Larry Summers and others have been going around giving talks that we're making a bad mistake in how we, a simple example of that everyone points out is this supercomputer in my hand here is, equivalent to a couple $1 million Cray 1 supercomputer. And so that everyone in my family can now afford their own private supercomputer that used to cost $1 million in 1970 dollars. Okay, and so we're not doing inflation or Wikipedia. And every middle-class family used to put $500 down into a World Book encyclopedias for their children that they now get for free or essentially free. And so that especially in items having to do with the digital economy, the inflation, it's not at all clear we're doing inflation right. And if you look at people's leisure time, it's going more and more into free things on the internet that we used to pay a lot for, just a long list of these things. And you can make a case that we're badly mismeasuring inflation. If that's true, it has real implications for Fed monetary policy. And I was wondering where what your attitude is on this part of the debate, because this, the digitalization of our economy is accelerating, and this is going to be more important in the future. Anyone want to?
I'm trying to pass this around. I think this is an extremely difficult question, and my own view is that these problems have existed to one degree or another for a very long time. Television is very much like some aspects of the internet. So television comes on in the 1950s and provides us with free television in exchange for advertising. Well, Google provides us with free lots of things in exchange for advertising, which then the advertising, of course, costs get impounded into the costs of all of the other products that we purchase. So the question is whether or not that's gotten materially worse. I love my supercomputer in my pocket as well, and I use it quite a lot. And it's much more than I would have put the price at more like $30 million in 1970 dollars than $1 million. It's a lot. But I think that are we today worse than we were, say, during the time there was the Boskin Commission in the 1990s that estimated the bias in the consumer price index at roughly 1 percentage point per year? 1 percentage point seems to me to be a reasonable number. That means that actual inflation is closer to 1 than to, when it reads 2, it's closer to 1. And
that has real implications, for example, politically, where there's a narrative that real wages have not gone up in the last generation, and you change that by 1%.
I agree with that completely. And the person who I would point to as the biggest champion of that is actually Martin Feldstein, who I think normally testifies for for your Republican colleagues.
Yeah. Let's see. I guess there's a line of commenting, actually, that's been happening about the politicization of the Fed. I was just wondering, when in the past have presidents seen fit to appoint, political operatives, campaign operatives, and speechwriters to chair the Federal Reserve? I'm aware of that's only happening one time in my historical knowledge. Is that any other example than Chair Greenspan?
I can't think of
a second example.
I mean, I don't think it's, just to answer that more constructively, I don't think it's about the personalities or the backgrounds of the people as much as it is about the incentives of the institution. So I think that's where
you
it
have
really
read Chair Greenspan's book. I take it you probably all have. And, you see, he talked, in glowing terms about his experience as a campaign operative and also his sadness about when George Herbert Walker Bush Sr., accused him of being responsible for George Bush Sr.'s losing the election because he appropriately tightened credit at the wrong time.
I know a little bit about that story if you want to hear about it.
Well,
So, I mean,
did he correctly report it to your belief in his book?
So Nicholas Brady told me, and he told me because he knew I was a financial historian and he wanted the record to contain this, that Alan Greenspan had made a promise to him that he reneged on. And I think that was the nature that in fact, George Bush's promise to, or willingness to consider tax increases was premised on that agreement. And so that's how Washington works, and you know better than I. And so I think a lot of the bitterness had to do with the fact that President Bush actually made a concession on tax policy, expecting the Fed to do something that they then backed out on.
I see. And is it fair to say, though, from my last question, that when, for President Bush II, when he had the opportunity to tighten credit at a time that you could make a strong argument for, that he did not repeat his mistake?
Bush, are we talking about?
We're talking about Bush II and the question of whether keeping the housing bubble inflating potentially to influence the reelection of George Bush Jr.
I don't know whether that was part of the calculation.
Okay. All right. Well, thanks much, and appreciate your.
Gentleman's time has expired. With that, we're going to wrap up the questioning. I've got a few comments and a few questions here, so we'll try to be brief here. Mr. Savant, all large banks have on-site examiners from the Federal Reserve. How has the Federal Reserve supervisory practices changed since the crisis? Have the supervisors been adequately transparent? I know you represent a lot of big banks with the Financial Services Roundtable.
Yeah, thank you, Congressman. It is true that the larger banks have on-site examiners. But I think in fairness, the supervisory policies of all the agencies have tightened since the crisis, the Fed included. And where we are at this juncture and what our testimony is trying to indicate is that we're at a tipping point where we think that there could be some refinements both in regulation and in supervisory policy.
Okay, I've just got a few thoughts here. We've had a very lengthy discussion today, and I don't want to drag this out any longer, but just a couple little thoughts here with regards to some of the comments that were made and some of the testimony that we've heard. I think, Mr. Savant, you made a comment with regards to stress test models, and I'm kind of concerned sometimes that the stress testing that is being done doesn't actually reflect a stressed or a situation that can actually occur. That's my concern with some of the stress tests. I know there are some difficulties in modeling because the Fed doesn't tell the banks how to to do this are kind of doing it on a guesstimate way of going about it, but at the same time, I'm kind of concerned that the way the Fed's modeling on these things is going, that they're really not modeling a real situation that could actually occur in today's world, and that's a concern of mine.
One of our recommendations to address that specific concern is that the Fed's model, the stress test scenarios, be put out for public comment so that they could be scrubbed and the Fed could benefit from that type of input from people
Dr.
here
Calamirez, you
on
have
this panel.
I agree with that. I have a specific version of that that I have proposed, but I also want to come back to the point of the stress test. The stress tests, using the current data, can't answer the question they want to answer. What they want to answer is, how will we be able to tell whether banks might be suddenly losing their economic value? That's what causes a crisis. The failure of banks to be able to roll over their short-term debt and to be able to behave normally reflects a sudden loss of economic value. That is not going to be captured unless you model the creation of economic value. You can't model the loss of it. Relying on book value of equity ratios and using the kind of data that are used in these financial reports simply cannot answer the question. So I would say that stress tests are close to useless as a forecasting tool for the sudden loss of economic value, and I don't believe the scenarios are very meaningful. So I do think currently they are not helpful, but they are currently, for most of the banks, the binding constraint on capital. So I think that's very troubling. So I'm a big fan of stress tests as an idea, but the current procedures have the secrecy problem, which is unaccountability, and therefore bad modeling is quite likely. But even more deeply, conceptually, they're just not addressing the right question, and they don't have the data to address it.
I'd just like to be the defender of what's going on today. I believe that the Federal Reserve is doing a reasonable job of this. I think they're trying to improve every day that they go to work to do a better job. I think they're trying to do that both on the modeling side, the scenario side, and on the side of the data that's being collected. What I would say is that I think we want to be very, very wary of transparency on the scenarios and on the models. I think that the idea that people are going to game the system is a very real one, and that we want to guard against that.
You know, it's interesting because in this very committee, and that's far corner over to the left, we had a stack of paper to represent 20,000 pages of what sometimes a small stress test is for some of these institutions. And it took up that whole table and then some. And yet, I don't know that anybody even reads it when it gets to the Fed. And so, as a former regulator, the Fed already has all this information. This is one of my concerns with stress tests. To me, it's an exercise where they don't seem to be willing to do their job, which is to assess risk themselves. The Fed does its own systemic risk analysis for all these institutions, yet I'm not sure why we need a stress test that's done by the bank itself, which seems to be a game of gotcha. Am I wrong?
If it were done properly, the stress test could answer questions. A well-posed question, in the event that these things happened, would you suffer a very large sudden loss of value? So I think it does have a function that's unique. I'm not against stress tests as an exercise. I just don't think they're currently ready for prime time.
My time's expired here, so we need to move on and let you gentlemen get home. And again, thank you for your expertise and your willingness to be with us and share your knowledge today. It's been a great hearing, and I thank the chairman of the Oversight Committee, Mr. Barr, for all his hard work and participation in putting this together and great comments. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask the witnesses to please respond as promptly as you're able. With that, this hearing is adjourned. We'll see you later.